Welcome to the Private Equity Experience Podcast, your backstage pass to the strategies, stories, and secrets that drive value in the PE universe. No filters, no fluff, just straight talk and expert insights to help you navigate the private equity world with confidence. And now your hosts, Ed Barton, Rory Liebhart, and Emily Sander.
The Pex boys are here.
We're back.
Sweet Eddie B and Big Red.
Good to see you both again. It's been I guess a few weeks now since we've been able to record.
It's
been a minute.
And then here we are at almost the end of the year. Can you believe it?
It's crazy.
Insane.
It's crazy.
Yeah.
Time goes faster as you get older. Is this just me?
Not just
No,
you.
because
In fact,
I've got a lot of older on both of y'all, and it don't slow down.
we kind of have three decades of generations, I think, amongst us actually.
Represented. Because
Yeah.
I remember as like a little kid, someone said like, "Oh, it'll be a year." You might have well said it'll be forever. Like
No.
it'll just be forever and ever. And I was like, a year is like not
No.
that long.
Not even. Yeah.
Do you guys do New Year's resolutions? You're like, if I have a goal, I just make it happen any month I want.
Yeah. The latter. I think I stopped being a resolutioner probably like 10 years ago. And, now it's just pretty much, year round, try to not get complacent, I guess.
Yeah. Do you like reflect on last year or you just like,
Oh yeah, absolutely. Usually it's building on last year, so if I've been, kind of doing certain things up to this point, I'm always trying to do more and, kind of progress, I guess. So yeah, it's never usually like, let me pull back on shit, to my detriment sometimes, but like that's generally how I go.
yeah. My new thing has been like process goals versus achievement goals. Cause I used to be like,
idea.
I want this, like,
Yeah.
revenue. I want this accomplishment in hand.
Yeah.
And I found it's much more about like, get the process down and like the rep is the goal. If you've done your rep, like
Good
that
point.
is
Good way to
winning.
say it. Yeah. I agree with that completely. But you keep stacking those reps, as you say, you will achieve those end goals, and then you have to reassess what the reps mean.
Yes. So we're going into 2026.
Yeah,
and we
it's
wanted
here.
to lay some groundwork and just kind of get some different elements on the radar for people about what the economy looks like, what the political landscape looks like, just different factors and different trends that might affect the private equity world.
Yeah.
So why don't one of you kick us off?
Well,
What's the first thing you should know?
the thing that everybody likes to talk about all the time, regardless of cycle, year, what have you, seems to be interest rates. So, as we've talked about ad nauseum, so much of the private equity business model is based on, leveraging acquisitions through debt. And so it makes a whole heck of a lot of difference how those trends move. And so, directionally or specifically how interest rates fluctuate, impacts how private equity operates in a lot of ways.
Yeah, I think the challenge that we've got is historically we were at historically low levels of interest rates, and so they tick back up to kind of a more normal level, which everybody's now screaming is like way too high.
Yeah,
and the challenge you have with interest rates. So I think there's political pressure certainly to bring interest rates down. And I think in advance of a midterm election in 26, there's going to be continued pressure to bring interest rates down.
Definitely.
I think Jerome Powell's time is limited, and there'll be a new Fed governor that's going to be appointed in part or based on their willingness to reduce rates. Now the challenge is, and I'm sure we'll touch on it more, but I'll touch on it now, is you also have that creates an inflationary specter because lower interest rates increases the availability of money. Plus you've got and I know Rory, you had kind of listed this as something to talk about, a deglobalization of the economy, which
never thought I'd hear that term in my lifetime, to be honest with you, but
which also is creating inflationary pressure.
Yes.
And so as a result, what we may see is political pressure pushing interest rates down some in 2026, but that's going to ratchet inflation unless the economy goes to crap.
Yeah.
And that's not normally interest rates falling stimulates the economy, which is another inflationary cycle.
Yeah.
And just as a quick like refresher for people, low interest rates good for PE firms?
Yes.
Generally, yeah. Oh, yeah.
Generally.
Just again back to the mortgage analogy we kind of thread throughout all this. You want your cost of money to be as low as you can get it. And as Ed said, we all lived off of really low interest rates for a long time. We're in the place where I think we certainly will continue to see like small basis point drops in the coming quarters in 2026, but credit spreads remain wide. So you have a base rate and then you have a spread above that rate, and that creates the volatility because it's a floating rate. It's not a fixed rate. So I think what we'll see is that interest rates will still be pretty high. So if you have a debt maturity coming up, you're going to have to deal with refinance risk, meaning, you're either going to have to pay the piper and then probably end up taking out more debt to fuel your business or whatever at a higher rate anyway. But it's not going to be as easy as it's historically been to refinance at a good rate. So
do PE firms build that in though, Rory? Like, wouldn't they
they
say,
do. Yes. Yeah.
assume?
I don't know of too many, certainly in my experience, maturity walls that have been hit in a real bad way. It happens for sure, but these are very, very sophisticated capital markets professionals that know how to hedge their risk and stuff like that. But nevertheless, it bears repeating that floating rate debt on the books limits your ability to operate if you have to pay more based on fluctuating interest rates and credit spreads. So
for years, we ran naked.
yeah, we did.
That'll be the clip for social media.
That's going to be the thumbnail. That's going to be a short in and of itself on YouTube. I love this. Yes, we did, Ed. We definitely ran naked together a lot.
Yeah,
but yes, we hardly hedged.
When you're looking at
working with you, I don't think we really ever hedged our risk.
Yeah, we rarely hedged
in that time frame. Yeah.
Okay, so we've got people running naked. We have something called floating interest rate. So basically, what was the floating spread you said, Rory? Like, basically, you can't predict it, is what you're saying.
Well, you got a risk premium.
That's exactly what it is.
So you've got a risk-free rate, which is going to be driven by kind of the interest rates that are set by the Fed. Largely sets the risk-free rate. It's theoretically supply and demand, but the Fed is providing supply at a certain rate. So that's your risk-free rate, and then you've got the risk premium over that, which is the amount that needs to be paid based upon the underlying credit risk of the.
Say the risk-free rate in what does that mean? Normal.
So the risk-free rate is essentially the amount of money you need to make a loan with no risk at all, with no risk of non-repayment. So the only thing that you're going to have as risk is inflationary risk. So that will inflation is about the only piece that impacts the risk-free rate. And then you have the risk premium, which is the systemic risk associated with either that specific credit or with the market as a whole. And there's all sorts of hypotheses at that. But at the end of the day, that risk premium fluctuates because if there's macro risks in the economy, folks go, even if I think inflation is going to be relatively low and risk-free rates low, some of these businesses, because they may have large amount of floating rate debt, they may have bullet maturities coming up, they may be long in the hold period for private equity, the risk goes up, and so the banks are likely to kind of put a bigger spread on the loans.
Yeah, and to your question about how does hedging come into that? So if your business is damaged by volatility in those floating rates, then you can hedge your risk by paying a bank or an intermediary to make it simple, fix the rate that you're looking for. And that comes at a cost. Again, there's risk to the other side. So you pay for that risk. So hedging simply means reducing volatility by paying it is actually called a premium when you do that, when you pay those amounts to banks and stuff. So yes, but depending on the complexity of your business or not, you don't need to hedge your exposure. And this is a good transition to the next trend that we'll talk about, which is, if you find yourself having to pay more in interest to service the debt, i.e. cash out the door, Maybe you didn't plan for that. Well, what are some of the other trends that we're going to see and one of those is labor. And you look at most companies, the biggest expense is, often other than debt service is labor, right? And so one of the trends to think about here is what's going to happen with the labor market. We're still at super, super low unemployment rates overall, but is that going to remain the case? Is the labor market going to be as tight? Are you looking at having to pay high wages against rising costs elsewhere, or high raises along or wages along with other costs that you're seeing? Do you have the pricing power to offset that? And conversely, to make room to pay for other costs that are unanticipated that come up, you probably have to cut into your labor force, because that's where you're going to see the most juice from your squeeze. So like that's why you see big companies making layoffs and adjusting their workforce to be more AI centric or whatever, is because labor is one of those levers you can pull in the cost side. And unless you think that the labor market's certainly going to become looser, meaning higher unemployment, so you don't have to pay as much to retain and buy talent, like that's something to have to consider. And if you're from a private equity standpoint, again, you're managing to a P&L, you're managing to a bottom line. You have to be nimble and able to manage, a workforce and labor in a way that allows you to continue to be profitable and grow profitability.
Okay, let me see if I can do like a real life example.
Yeah.
So let's say a few years ago, PE firm made an investment at pretty low interest rates. Like these were like record low interest rates for a while. Yes.
Mm-hmm.
And now the debt maturity has come up and they might have to refinance at a higher rate.
Mm-hmm.
So they're like, okay, boom, on our books, we have this, I don't know, 1, 2, 3, 4% more that we just have to pay.
Yeah.
And then people want raises and they want COLAs and all these different things. And you're getting crunched from those two ends. Yep. And you might go, we need to do a round of layoffs now.
Yeah.
Anticipating that a whole bunch of other people are going to do this. So if we need to bring high talent back into our company, we're going to have a lot of supply. Is that kind of what I'm hearing?
Well, in our current market, it means there's still a lower supply. It's hard to get talent. Now, I think and this is the trend, I guess this is the part we're talking about. I think everybody sort of sits on this fence with AI, and that'll be another trend on its own that we'll talk about, is to say, is the labor market going to loosen up? Because you're going to start to see, let's say there's somebody that leaves their job. I think every manager now is really thinking about, can I use AI to replace that role? Mm-hmm. Do I need to requisition new roles? So business plans, operating plans are basically being developed for the coming years based on how much do I actually need to spend on human beings with the advent of AI. Now you get into other things involved with CapEx spend to develop AI for your company, but that's a whole other ballgame. Point is, the labor market and the dynamics in it are going to be really interesting in how you can manage a business, either, in a market where labor is expensive, or, perhaps there's going to be more supply, as you said, because of tools and technology and basically contraction.
Okay. And I was thinking there'd be more supply because if a whole bunch of layoffs happen,
that's true. Certainly
there would be more. But you were saying that there'd be less.
So just to understand, what seems to it's very possible, but like, again, I think maybe that's the next trend to talk about, even, is the AI component, is like, really, where is that going to affect labor force?
Oh, I see what you're saying.
I think white collar jobs, as they say, probably the most. I'd say mid-level functional work, even some level mid-level managerial work. That's going to be more where companies are going to at least experiment with using AI as opposed to humans. You're not going to see people that are farmers using AI to drive tractors and plow fields right now. Like, that's not where it's going to come from. Maybe in the future, but right now it's going to be, law firms, accounting firms, you name it, service-oriented tech firms that have people that do things that are repeatable and can be sort of 24/7 working through AI bots and agents is going to be, companies are just, sort of being forced by the market to experiment with these things. If you're not doing these things, you're looked at as a laggard, and there's maybe some actual merit to that. We shall see. It's so new. I think that's going to be the topic everyone's talking about for the next year or two,
Okay.
probably.
So you're saying because AI is coming in, there
Mhm.
might be
Yes.
less. Okay.
There will be. There will be. I mean, it's
Yes.
not a matter of if, it's a matter of how much.
And where and how and all those
Yes,
things.
correct.
How do you, like Ed, how do you use AI? Because you have, in your accounting
Yeah.
practice.
Yeah, we use it for a couple things. The first one is when people call in and they ask weird esoteric questions. And we kind of pop those weird esoteric questions in there. And I've told our folks, don't take the AI as gospel.
Right.
But it's at least an epistle. It's sending you the right direction, and then you can kind of figure the stuff out as you go. So we use it there. We also use it to summarize. So if I've got a large document, so for instance, we've got a contract
Yeah.
that we're asked to review, I'll drop a PDF of that contract into AI and go, summarize this or basically abstract this contract for me. Now, again, that's always going to leave stuff out by nature of it being an abstract, but it does kind of cut it down to the critical issues. And then the systems themselves are becoming more AI infused. So when you look at like a QuickBooks Online,
Yeah.
there's already, kind of a set these business rules so that stuff will automatically post. It now is going, okay, we're matching, automatically matching various bank statement
Yeah.
entries to various bank transactions and clearing those automatically. And so all you have to do is validate. So what used to take us 2 or 3 days to close a client may now take us a couple hours. And so that's being driven, AI is a broad term and everybody
It
kind of
is,
thinks
yeah.
about it differently, but as simple as machine learning, the kind of the old school AI that's been around for 20 years is infused in all of these programs now, and it's continuing to broaden.
Yeah.
Yeah.
Yeah. It's interesting. Like, where does PE figure into all this? So certainly from the opco, meaning operating company level of their investments, I think there's going to be a big push from the PE funds to enable and sort of pressure management teams to adopt this level of technology because it does have such power to harness. Now, again, the cost to implement it could vary by industry, by kind of company, of course. But I see it equally where PE will use the technology as a tool to enhance the businesses they own, but also perhaps investing in AI becomes much more of a PE play than just pure venture play. So early stage investment. So I can see a situation where PE funds kind of set up an AI strategy, raise a bunch of capital for that alone, and then aggregate up companies that I think could go two different ways. Growth stage, right? We talk about growth stage private equity investment. That could be very, very much a fruitful channel. The other one, and I hate to be Dr. Doom here, there are going to be a lot of blowups no matter what. It's going to always happen. This is where PE comes in and sort of acts as that sort of distressed investor, buying up companies that are distressed and maybe turning them around or bolting them on to existing portfolio companies that they have to give them a second shake at life if they've actually got some sort of a product that actually matters.
Oh, if a PE firm wanted to be totally contrarian on AI, how would they? Is that the closest way
How
they would
do you
do
be
that?
contrarian on AI? You basically strip all your computers out of your company and do everything by hand. No, I'm kidding.
No, no more internet.
Be contrarian. God, that's a good question. I don't know how to answer that because I just feel like it's going to be just so much of it's almost going to be like a commodity. It's going to be incredibly ubiquitous. There's no way around it,
Yeah, I was almost thinking more. There's the contrarian. If you want to go, okay, what does contrarian mean?
Right.
And I tend to view it as, are there folks that are, and I go back to the internet boom, which again, you guys are probably both.
I was around for it. Yeah.
Okay. So, but I look at it and go, the folks that did fairly well, you had a few kind of big movers like the Amazons and such that survived and thrived. Most blew up, and I think we'll see the same thing here. And where I think private equity has the opportunity, as opposed to venture, where venture is going to make a lot of these bets and hope that some of these pay off and the consolidation happens and they get cashed out one way or the other. I think on a private equity side, we are going to see investments in later stage companies. But on the contrarian piece, I think it's going to be the picks and shovels folks. So AI is going to be here. There's a huge power consumer. So, if I don't want to invest directly in AI because I don't want to bet on the winner, but I want to bet on the sector moving forward and having additional consumption of electricity, where can I invest as a private equity firm to take advantage of that in data centers?
I mean,
what can I do to play in that space, knowing that certain elements of it are going to blow up, but that it's not likely. It is here to stay, and it's going to continue to move forward. So I don't think you're going to get contrarian. I think you're going to get more peripheral.
I agree.
And I'm not trying to pick the winner because I don't know if I can do that as a private equity investor. I'm going to have a lower risk tolerance, but I will look at the sector itself and go, what tangential sectors, what peripheral sectors support this new phenomenon, and how can I kind of ride those coattails up?
Yeah. One other element I could see being interesting is and it kind of figures into the growth stage, but it also figures into just like a lot of times PE will come in and a business is stalled out. They've taken their business to a certain point and ran out of capital before they could bring it to the next level. I see a lot of companies that are kind of moving very quickly to invest in CapEx, capital expenditures towards AI adoption, things like that. But if there's any sort of shift on the top line for these companies that doesn't support their internal growth, they're going to have spent all this money and they're going to reach a standstill. And so it's going to require more capital to move it forward, at which point that's when it's not quite a distressed company, perhaps. I guess if it's close to running out of cash, it is, but it's maybe like not the same thing as a growth company. It's more like you had a contractor come in to build you a new kitchen, and that contractor itself ran out of steam to be able to do it. So you bring in another contractor to pick it up and bring it to the end of the project. I see a lot of scenarios possibly going that way, where companies made big bets and say, okay, I'm going to put a ton of my operating budget this year into AI implementation, not just adoption, but implementation, fail, and they're left with, what do I do next? So, probably that owner is going to be like, okay, I need to sell part of my company to get an infusion of capital to take this thing or finish the job, so to speak. I can see that happening a lot.
When do you think that, so there's this wave of AI companies that are coming up, like almost a tidal wave of them, and you're saying, hey, there's going to come a point where they run out of cash, or they have done all they could, or some of them flounder.
Yeah.
But there's going to be that
bad management teams, no bounds. I mean, like, you can have all the business, ideas and sort of like business plan, but if it's a bad management team, it's going to fail. And we know that about humans, is there's bad managers and there's bad management teams. So no matter what sector you're in, it's going to happen. And it's going to happen in this one too, for sure.
So a savvy PE managing director would know, hey, in about 12, 18 months, whatever you think it's going to be, this is going to be a frothy market in terms of these,
18 months to 24 months. Yeah, that's kind of the timeline, because whatever companies had raised, up in their earlier round are going to have burned through that runway by 2 years. And so that's going to be, So I do think that, as we're talking about 2026 specifically, you're running up on that timeline from when this fervor started. We're kind of like 2 years into where it went from being talked about a little bit to you can't get outside of a single, kind of earnings call without heavy reference to AI. So everybody's in it. Everybody's put a ton of energy and effort into it. And now it's going to be a time for reckoning, I think, after that initial flood of capital has gone through it.
How does deglobalization affect this?
I don't know if deglobalization is a thing if we didn't have the current administration in the United States of America, but we do. And I think that, there's much more of a nationalist, protectionist sort of vibe, and the tariffs, kind of support that. So what does that even mean? It means that you have to rethink your entire business and supply chain a lot of times, depending on the kind of business you are. Whether you're a manufacturing business or you're a goods importer, you're a reseller, whatever the heck it may be. You rely on overseas labor. Who knows? Like, you rethink things.
Yeah, I mean, Rory, you and I had a mutual connection in Canada
Yeah.
in the
Yes.
manufacturing space. And when tariffs hit, that was, 30, 50% more expensive.
Major impact for a lot of these companies. And Canada's our neighbor just to the north. We're not even talking, overseas.
See it out the window.
Yeah, exactly. Yeah. What does that mean? It kind of comes back to a lot of the things we've talked about, is that has to be offset. So the higher costs associated with deglobalization have to be offset by, at the front end in some ways, how much pricing power do you have over your customers? And what levers can you offset internally? So do more with less. Sure. Seems to be that philosophy seems to know no bounds on economic cycle. It's always that, but it just, there's so much, I guess the whole point is a whole other level of discipline is required to maintain profitability in these businesses, because we're fighting against things that we haven't dealt with really.
Well, the other piece on the deglobalization side is a lot of that has been focused on manufacturing, because, as you noted, the current administration's view is, can't we just go back to 1951 again and have smokestacks and steel mills and other things? And there's some
Right.
national defense reasons why we may want to preserve some of those industries, but where it hasn't been impacted and where I'm still seeing significant opportunity is the use of offshore labor in the services industry. And so again, where deglobalization is hitting hard in agriculture and manufacturing and services, I think globalization continues to be a thing. And I'm just kind of hoping, because again, our model, we utilize a global workforce.
I have team members in the Philippines. Yep.
And so what I'm hoping is that the administration doesn't think about that. And that no one from the administration watches our podcast and decides to just leave, global labor alone. Now this is not just a Trump administration thing. The Biden administration had some protectionist policies as well. And I think it's been an evolving, it's interesting because, the globalist or protectionist trade has tended to be more of a, driven by labor unions and
Right.
typical traditional democratic strength areas. And now you've got a populist government that has essentially said, hey, we're buying into this too. I don't think it's going to make a difference in 3 years who gets elected president. I think you're going to continue to see this deglobalization trend for at least another 7 years or so, until hopefully some folks kind of moderate the tone and temperature. But it's a red meat electoral issue, and folks like to be able to have their jobs and the steel mills and the smokestacks and stuff.
Yeah.
Why does that make pricing power non-negotiable?
Well, I'd say it's just pricing power. It's non-negotiable. You to be successful, you got to have pricing power. So you need to be able to pass those costs on to your customer. And like the example you brought up, Emily, like where a Canadian company that manufactures in Canada but sells in the U.S., like you have to be able to pass the inflated cost to the customer to be able to survive, even potentially. At best, it's eating into your margins. At worst, you just can't be viable, because you're gonna
Is that
burn cash flow.
Is that the only way to do it? It's just you pass on the cost to the customer?
Or you cut other costs from your own business. Yeah. Again, this is assuming you want to continue to maintain or expand your margins. If you're okay with contracting margins, you're betting on the long game, then that's a different story. But yeah, you have to be able to, it's a zero-sum game at the end of the day. You have to be able to, offset your costs with additional business, or, take out costs if your business is reduced. Yeah.
Well, I'm assuming that in some scenarios, that's the smart, savvy thing to do is like, let's ride this out. We'll take a lower margin
Mhm.
on the fact that, hey, we'll survive this.
Yeah,
We won't
and
lose our
many
company,
companies are
we won't
doing
have
that.
churn,
Yeah,
and we'll be able to bring things back
yeah,
eventually.
exactly.
Ooh, that's risky though. That's like
Yeah,
going through
yeah,
a tunnel, hold your breath type of thing.
yep,
Okay.
yeah. But what choice do you have as a business owner, really? You know, like that,
Times
you're sort of backed into a corner that way. Yeah, yeah.
What else do people need to know for 2026? Private equity.
I think overall it's not going to be a year of huge expansion. I think it's going to be a lot of sort of eking out profitability on the margins, literally, meaning like you're not gonna necessarily expand your returns on investment or your margins based on use of leverage and financial engineering. Maybe that's the way to say it. Financial engineering is not going to be the way you get your returns. The way you're going to get returns is smart, fundamental business management, really. And so it's kind of boring to talk about, but I think that's certainly the direction it's going to go for 26, which is really just a continuation of 25 is another way of saying it, kind of.
Yeah, fewer home runs, a lot more singles and doubles.
Right.
And singles and doubles are going to be successful because I think, again, when you look at the environment under which a lot of these portfolios were built, back from 2018 through 2023, it's going to be difficult to be able to not strike out on a number of those.
Yeah.
So, it is going to be, I agree with Rory, it's going to be a lot of scrapping to just try and get some reasonable returns. And the macro environment is not going to make that any easier.
Yeah.
That's putting challenges and roadblocks in the way of every one of these private equity managers, and really the most talented ones and the ones who bought right will be the ones that are able to get the returns, and you make the money on the buy.
Correct. Yeah, and I think so. That's a key point to speak about. Don't get me wrong. My perspective is not that there's not opportunity to be an investor as a private equity investor. I think that's actually going to be the place where you can make some hay is on the buys. There's going to be a lot of opportunity to buy. There's still a ton of capital on the sidelines, and you just have to look for deals that are going to be undervalued, if you will, and then sort of, even if you perform normally, you'll make your return on the buy, as Ed said. Yeah.
Let's do a little prediction round. So if we're sitting here December 2026, we've kind of talked about what might happen in the PE world. So you can make PE predictions or other predictions. So like in real time now, we could do like, who's going to win the Super Bowl in NFL football? Not the Chiefs.
Definitely not the Chiefs.
No.
Definitely not the Chiefs. That's a good question. Seahawks look good. I'll just say that. So does LA Rams, though. So
yeah.
I'm leaning the Patriots.
Ooh, Drake May.
I think it's going to be the Patriots. I think they've got an easier walk to the Super Bowl than anybody in the NFC. The NFC is just going to be a dogfight, and then whoever comes out of the AFC is probably. I think the Patriots are going to cruise through the playoffs, and then they're going to be in a really good position with a lot of confidence going into the Super Bowl.
Against
I think whoever the NFC team is going to have gotten beat up. I don't think it's going to be the Eagles. I think the NFC is going to. I think it's going to come down to either Seattle or LA, but I think whichever one goes forward is going to lose.
Yeah.
Wow.
Defense wins games. Yeah. Ed, how bummed were you about Notre Dame being left out of the dance for college football?
It was a little bit ridiculous. The fact that Alabama jumped Notre Dame and was selected as in an at-large with more losses and not having the same record against top 25 teams, I think was a travesty. Now, I think the SEC probably has a significant influence upon the selection committee.
Yeah.
And I think Notre Dame's now the flip side of that is Notre Dame decided that they were going to give a one gun salute to
Yes.
ESPN on the bowl games and basically say, well, you're not going to get any money out of us by showing up at a second tier bowl,
Right.
because you played us. So again, I'm hoping that the team made that decision, the players, not the coaches administration, solely because this is their college football experience.
Mm-hmm.
But I can't say that I'm saddened that Notre Dame gave them one gun salute.
Yeah. I hear you. Yeah. I think it'll be the other team from Indiana that gets it done, although it'll be a rematch against Ohio State, I think. So, yeah.
Who wins the championship? It's like Georgia seems to be in the thing every year.
They are. I think they'll be formidable. I think it's going to be a Big Ten team this year, either Indiana or Ohio State. Yeah.
Ohio State.
We'll see. Sure as hell can't beat Oregon. That would be a real problem.
All right, we've got some 2026 predictions for our listeners in the sports world and private equity.
Yes.
Anything else for the good of the
buy low and sell high is all I got to say.
All right. Thanks, Ed.
Thanks, Em.
Thanks, Big Red.
Thanks, Em.
If you enjoyed today's episode, please like, share, and subscribe wherever you get your podcasts.